The best company in the world can still be a terrible investment if you pay the wrong price. Screening tells me what's worth looking at. Valuation tells me what it's actually worth and whether the price makes sense. This is where most people skip a step. I don't. Last time, my screen handed me a ranked shortlist, Tier 1 names that passed both my ethics and my financial gates. But here's the trap. A high screen score is not a green light to buy. A great business at a rich price is still a bad deal. So before a single trade, every survivor has to answer one question. What is it really worth? Price is what the market asks today. Value is what the business is actually worth. They are not the same thing, and the gap between them is everything. When value sits comfortably above price, that gap is my margin of safety. Room to be wrong and still come out fine. No margin of safety, no trade. To estimate value, I never trust a single method because anyone can flatter a stock. So I use 4 lenses. 1. Discounted cash flow. I project the company's future cash and bring it back to today's money. 2. Earnings power value. What it's worth on today's earnings alone, with zero growth, my conservative floor. 3. Multiples. What the market pays right now for similar companies. And 4. Forecasting. I project earnings 3 years out, using my own estimates or analyst consensus growth, then value those future earnings against the P, E, and PEG the market has actually paid for the peer group. For lenses, 1 picture. Each lens runs on a few inputs: revenue growth, margins, the discount rate, and the multiples the market is willing to pay. Small changes move the answer a lot, so I run 3 scenarios: low, base, and high. I'll build a full model, step by step, in its own video. The point for now, each lens gives a range, and, crucially, I check whether the lenses agree. Let me run it on the name that topped my screen, Sitronix. Sample, not advice, as of my May analysis, when it traded around 290 Taiwan dollars. Earnings power, my no-growth floor, about 310. Discounted cash flow, base case, around 388, with a bull case past 430. Multiples versus peers, cheap. But my 4th lens, forecasting earnings onto the price to earnings the market actually pays, came back lower, near 230, calling it expensive. 3 lenses said undervalued. The 4th said the opposite. So the verdict: blend the 4 lenses, and Sitronix comes out undervalued. A fair value around 310, a base case near 388, against a price of just 290. 3 of my 4 models see real value on the table, and that earns it a spot on my buy list. But here's the discipline that keeps me winning. I don't pay almost fair. I want a genuine margin of safety, a clear discount to fair value, before I commit. So the play is simple. Buy on weakness, with that margin of safety locked in. Until then, it goes on the watch list, and I let the price come to me. No chasing. No fear of missing out. The homework's done. Now I wait for my number. That's how you buy great businesses without overpaying. Screen, then value. That's 2 of the 3. Ethics gets me a clean universe. Valuation tells me what it's worth and what to pay. And one important reminder before you go. Everything I share on this channel is for education only. It is not financial advice, and not a recommendation to buy or sell anything. I'm simply explaining my own framework. Always do your own research, and if you need advice, speak to a licensed professional. Next, in part 3, how I actually manage the positions I buy. Sizing, tracking, and knowing when to sell. Subscribe, and I'll see you there.